Welcome to Chapter 3 in your Cornerstones textbook. In this chapter, we will be covering the adjustments in the accounting cycle and how we finish the last few steps of the accounting cycle itself. Now, the elements of accrual accounting are very important to the adjustment step in the accounting cycle. Accrual accounting assumes three major elements. The first is that any business can determine its own time periods. And sometimes these may seem arbitrary, but essentially time periods can be 1 week, 1 month, 1 year, and they can begin and end when the company determines. The second important principle or element of accrual accounting is that revenues are recognized when they are earned. That means when the company has done the work to earn the revenue, not before and not after. The third important element of accrual accounting is this. It's called the matching principle. And the matching principle says that expenses are recorded when they are incurred. Now, when they're incurred is a special accounting term that says they can only be incurred when the revenue was earned. The revenue associated with the expense has to happen at the same time. So revenues are recognized when they're actually earned, and expenses have to be matched in the same time period as the revenue was recognized. Now, accrual accounting is versus cash-based accounting. Cash basis records items whenever the cash flowed in or out. So whenever cash flows in, we record the revenue. Whenever cash flows out, we record the expense. However, it's different from accrual accounting, specifically in terms of when revenues are recorded and when expenses are recorded. In cash basis accounting, there is not a link necessarily between the revenues and the expenses. However, in accrual-based accounting, there will be a link between the revenues and the expenses. In your book, Cornerstone 3.1 provides you with a little bit of an example so you can try to understand the difference. Read the information for Conservation Inc., and then we'll actually answer the questions. You should pause the video here while you read all the information. Now, if you notice in this cornerstone, the company Conservation Inc. has a client. In this case, it's the state of Georgia. And Conservation Inc. is doing some analysis on providing water for the Atlanta metro area. There are $60,000 of expenditures associated with this particular job, and there's $100,000 in revenues. Now, if Conservation Inc. were a cash-based accounting company, then they would record the $60,000 of expenditures whenever they occur, right? And when they paid the expenses was paid $60,000 of expenses in December 2011. So if in the cash basis of accounting, we record expenses when the cash flows out. That would be December. When did the cash flow in for the revenues for the job? Well, according to this, it was January 2012. So if it were the cash basis of accounting, then Conservation Inc. would have recorded the revenues in January. Now, in accrual-based accounting, we say that we recognize the revenues when they're earned, and we match the expenses associated with those revenues to the same time period. When did Conservation Inc. earn the revenues for the job it did for the state of Georgia? Yes, they actually did the investigating, the earning of those revenues in November 2011. And when did they actually incur the expenditures associated with that job? Well, in the same month, November 2011. So in the accrual basis of accounting, we would actually have said that the revenues and the expenses were both recorded in November. And notice this is exactly what happens. In the cash basis of accounting, we paid the expenses in December, so that's when we recorded them. We received the payment for the revenue in January, so that's when we recorded it. However, in the accrual basis of accounting, We performed the service and incurred the expenses both in November, and so that's when we record them. We record nothing in December and nothing in January. Now, because of the revenue recognition and the matching principles, we end up having adjustments that we need to make. We make adjustments in step 5 of the accounting cycle. There are 4 major ways to make adjustments. We make them because of accrued revenues and or accrued expenses. In both cases, accrued revenues or accrued expenses are previously unrecorded items that have either been earned or incurred, but the cash didn't change hands yet. So an accrued revenue is a previously unrecorded revenue that was earned, but the cash hasn't been received. An accrued expense is previously unrecorded expense that was incurred but hasn't been paid for in cash. Deferrals are more or less the opposite. Deferred revenue means the company has received the cash but hasn't earned the revenue. So it has created an unearned revenue, which is a liability. A deferred expense means the cash has changed hands. The company has paid for the expense, but the expense has not actually been incurred yet. So there is a prepaid expense, which is an asset account, sitting on the company's balance sheet. Let's talk about accrued revenues. Remember, these are transactions that are not yet recorded for revenue that has been earned. So when we journalize an accrued revenue transaction, we always end up having a receivable account, which is an asset account. And if that's the case, when we increase an asset, we have a debit. And we're going to have a revenue account, because remember, the revenue was earned. And a revenue account is under the stockholders' equity section, and whenever we increase the stockholders' equity, which is a revenue, we have a credit transaction. So an accrued revenue journal always includes a debit to a receivable and a credit to a revenue account. Let's look at Cornerstone 3.3 for an example. Porter Properties, what it does is it rents office space. It has a client. It rented office space to the client, Tiger Travel Agency. It did so on November 1st, 2011, and the rent was $5,000 per month. However, Porter requires Tiger Travel to make a rental payment at the end of every 3 months. Does not require them to make a payment at the beginning. This means that Tiger Travel is not going to pay anything until the end of those 3 months. That would be November, December, January. So Tiger Travel is not going to pay any cash until the end of January. However, Porter Properties is a company that closes its financial books at the end of every calendar year, which means at the end of December. Even though no cash will have been received for this transaction as of December 31st, Porter Properties does need to recognize the revenue. So, how would it make a journal entry to recognize the revenue that it will receive from Tiger Travel Agency? Well, how much revenue has it actually earned? It has earned the rental for November and for the month of December. If that's 2 months of rental at $5,000 a month, how much revenue has it earned? Yes, $10,000. And a revenue should be a credit entry. Now, has it been paid this $10,000 yet? No. No, Tiger Travel is not going to pay until the end of January. So there is a receivable of $10,000 also. And let's look at that nice and neat and clean. We've got the date as of December 31st. Porter Properties would be owed $10,000, a rent receivable of $10,000, and it will have earned 2 months worth of rent, which is $10,000 credit entry because it's a revenue, and we have a memorandum for this transaction. Now, we know that on January 31st, 2012, the next year, Porter Properties will actually receive the cash from Tiger Travel for the full amount of 3 months of rent. Now, how much is 3 months of rent? Right, $15,000. So it'll receive cash of $15,000. But then what happens? Well, remember, in December, it had already recognized $10,000 of that $15,000. So it can't record a full $15,000 of revenue anymore, right? Okay, but on January 31st, it will have earned an additional $5,000 of rent revenue. And guess what? It now gets to clear that rent receivable. Let's check that out. It receives $15,000 in cash, which is an increase in an asset. So the debit to cash. It did earn an additional month of revenue, which is $5,000 credit entry, and it cleared that rent receivable, which was $10,000. So it was a debit to receivables previously, but now it's clearing it out because the receivables getting paid. So it's a credit because we're decreasing an asset account. We record the date, which is actually incorrect here. So this is where you get to correct the PowerPoint. January 31, cash is received, and we have a memorandum to that effect. To round out our discussion on accrued revenues, if the adjusting entries were not made, we would be understating our assets. Remember, we wouldn't have those receivables in there. We would be understating stockholders' equity, and that's because we would have understated the revenues or the net income. We record accrued revenues to keep ourselves consistent with the revenue recognition principle. All right, let's now look at accrued expenses. Remember, accrued expenses are previously unrecorded expenses that have actually been incurred, but they haven't been paid for in cash yet. Now, if you haven't paid for something in cash, it means you've got a payable, right? And if I increase a payable account, that's increasing a liability, which is going to be a credit. And I've got an expense. It is actually an expense that has been incurred. And remember, all increases in expenses are a decrease to stockholders' equity, which means it's a debit. Let's look at an example. Cornerstone 3.4 in your book. We're back to Porter Properties. They pay their clerical employees every 2 weeks. The employees work 5 days a week. So every 2 weeks they're getting paid for 10 work days. The total wages every 10 work days is $50,000. Now, when they hit December 31st, 2011, which was the end of the calendar year, that means they have to close their books. They were 4 days into the 10-day pay period. That means on December 31st, we have got to fix our expenses. We've got 4 days worth of expenses that were actually incurred, right? Well, how much is it per day? Well, let's think this through. If 10 days of wages is $50,000, then it's $5,000 a day, right? And we had 4 days that we need to pay for, 4 days of wages that are salaries rather, that are actually incurred. So 4 times $5,000 is $20,000. So we know that there must be $20,000 of expenses that need to be accounted for. So let's check that out. On December 31st, salaries expense needed to be increased, which is a debit, by $20,000. But they weren't actually paid for. No cash had actually changed hands. So that means as of December 31st, there was also a payable, which is a liability, on the books for $20,000, and that would be a credit entry. And we've got a memo to that. Now, at the end of the 10-day pay period, which would have been January 10th, Porter Properties is actually going to pay the employees. Now, remember, they recorded 4 days worth of expense already on December 31st. So when they get to January 10th, they don't want to double count that expense. They have to make sure that they only are counting the additional 6 days of the salaries that are actually an expense as of January 10th. So they already already expensed 4 days worth. We got to expense the other 6 days. That's going to be $30,000. Plus, as of January 10th, they actually get to clear that payable. They're now going to pay it. So they need to get rid of that payable off their books. So they're going to debit the payable for $20,000. And since they're actually paying it on that day, they're going to send $50,000 of cash out the door, which is a credit. And if we were going to be completely correct in our analysis, we would make sure to put a memo there. What would the memo actually be? Yes, the memo would be record expense and the payment. All right, to round out our discussion on accrued expenses, if the adjusting entries were not made, we would be understating the liabilities, because remember there's payables involved, and we'd be understating expenses. If we understate expenses, that means we'd be overstating income, which causes us to overstate stockholders' equity. We record accrued expenses to be consistent with the matching principle. In the next video, we'll move on.